Bismillahirrahmanirrahim. Welcome to my business educational platform. I am going to start another course that is known as Introduction to Business Finance. So first we will discuss the introduction to course, what we are going to study in this course. Then we will see the course outline and then we will start the first chapter of this course. So what we are going to study in this is the basics of finance and how the finance is used in businesses, how the businesses finance or outsource their money, how the businesses manages their finance, the best utilization of businesses money, the return earned through its efficient management. So here is what the course outline is. In first we will start the first chapter of business finance introduction, then we will move forward to the financial environment, time value of money, valuation of securities, risks and rates of return, financial statement analysis, cost of capital, capital budgeting techniques, working capital concepts, dividend policy, capital markets, long-term securities, and finance using spreadsheets. If there is some time, then we will also touch the finance using Excel or spreadsheets. So here is what the suggested reading is. The books we will follow: The Fundamentals of Financial Management, 7th edition by Eugene Brigham. We will also touch the book of Fundamentals of Financial Management by Wayne Horn. We will also touch the Fundamentals of Corporate Finance by Barely Myers, and we will also touch the Corporate Finance by Ross Fosterfield Jordan. So what is finance? Whenever you think of the finance, you will listen the word money. But finance is something different. That is attaining the amount of money, using it by investing and gaining return on your investment. So finance is all about attaining your money, how you are going to attain your money, then using it in order to get some return on it. Using means where you are going to invest it and then you will get some return on it. So basically the finance is the attaining the amount of money, using it by investing and gaining return on your investment. So here is what the finance interrelated areas. There is the one financial management. There is the separate book on this and we will touch this chapter separately. The financial management discuss the decisions within the organization, how the finances are being made, from where the finances are being made, and how the companies, organizations use their finances in order to get certain return. So then there is the investment, institutions and individual decisions. From if you will make the investment, you will look for the returns. So from individual perspective it will be the return, but from the organizational perspective it will not be the return. What organizations have to do, organizations have to make the shareholders wealth maximization. So there comes the differences. From investment from individual perspective will be the for the returns, but from the organizational perspective it will be the shareholders wealth maximization. Then we will see the financial markets and institutions, that includes money markets, capital markets, charter markets, banks and other financial institutions. So then there comes the role of financial management. What is financial management? The goal of firm, organization of financial management and functions. So what is the financial management actually? It concerns the acquisition, financing and management of assets with the overall goal in mind. So what will be the goal in mind? The shareholders wealth maximization. It deals with the acquisition, financing and management of assets with some overall goal in mind. Asset is something that you have control over it and it contains some value. So financial management is financing the money. There are two ways of financing: the short term and long term. In long term we have debt and equity. So we will discuss them in later, but here what we have to understand is the definition of financial management. It deals with the concerns acquisition, financing and management of assets with some overall goal in mind. Then we have the investment decisions. Most important of three decisions include what is the optimal firm size. If you will make the investment into the organization, then you will see the optimal firm size, the overall wealth of the organization. Then what specific assets should be acquired. If the organizations will be invest, then it will see what assets should be acquired in order to get some certain returns. What assets should be reduced or eliminated. If some assets become out of the range, then how should we how should be they be reduced in order to get certain returns. So what are the financing decisions? They determine how assets will be finances will be financed. So in balance from balance sheet perspective, we have the left hand side and the right hand side. The left hand side must be equal to the right hand side of the balance sheet. So that is what all we have to deal with the assets. We should balance the left hand side and the right hand side of balance sheet. The balance sheet shows the financial position. I hope you understood the concepts of the financial position of the balance sheet. That shows the financial position of any organization. So what is the best type of financing? Either we are going for debt financing, short-term financing, long-term financing or equity financing. There exist the major two types of financing. Either we should go for debt financing or we should go for equity financing. So what is the best financing mix? How much we should finance from the debt side and how much we should finance from the equity sides. So organizations don't took their own money into the organization. What they do, they finance from the others. So for that purpose they use the debts. In debts they provide some certain sort of interest as a return to the investors, and from the equity perspective they provide certain returns and dividends in order to get the equity finances. Then what is the best dividend policy? When the dividends should be distributed, and how will the funds be physically acquired, how we will acquire the funds. Basically organizations share the notification into the newspapers that we are financing, and if you are willing to purchase, then we will provide certain sort of returns. So then we have the asset management decisions. How do we manage existing assets efficiently in order to get certain returns? So basically purpose behind every asset management is the getting returns. So financial manager has varying degrees of operating responsibility over assets. Greater emphasis on current asset management than fixed asset management, as the current assets are the assets that will be used in the operations. Like inventory, we have in current assets we have inventory or cash. So what will be the emphasis? Emphasis will be on the current assets rather than the fixed assets. So what is the goal of firm? The goal of firm is the maximization of shareholders' wealth. You will see that the goal of firm should be the profit or the earning per share, increasing the earning per share, but they have certain implications. That's why the goal of the firm is the maximization of shareholders' wealth. It create value creation occurs when we maximize the share price for current shareholders. And who are the shareholders? Shareholders are the ultimate owners of the company. They provide the financing to the companies. And what are the sources of finances? There are two sources of financing. Either we should go for debt. If we are going for debt, then we will provide certain sort of interest to our investors. If we are going for equity financing, then we will provide certain returns and dividend to the investors. So what we have to do, we have to maximize the shareholders' wealth. Who are the shareholders? Shareholders are the ultimate owners of the company who provide the financing needs to the organization. So what are the shortcomings of alternative perspective? Alternative perspective includes the profit maximization and the earning per share maximization. So maximizing the firm's earning after taxes. What is the profit maximization? It is the maximizing the firm's earning after taxes. It has certain implications or the problems. It could increase current profits while harming firms. Ignore changes in the risk level of the firm. It only maximizes the profits, not the current assets or different management issues, common stock to buy T-bills, etc. It ignores these things and ignores the risk level of the firm. Then we have another shortcoming of alternative perspective. The alternative perspective include the earning per share maximization. If we will only maximize the earnings after taxes divided by share outstanding, then we have the certain applications. It does not specify timing or duration of expected returns, ignores changes in the risk level of the firm. Strength of shareholder wealth maximization. What are the strength? Why we are going for the shareholders wealth maximization? Why it is used as a common goal of the organization? It takes account of current and future profits, and it also looks for the earning per share, the timing, duration, and risk of profits, and dividend policy, and all other relevant factors. The share price serves as a barometer for the business performance. So it serves as a barometer of the performance. So then we have the corporation, modern corporation. How the modern corporation is operated? It is operated using two types. It is operated using shareholders and the management. Who are the shareholders? Shareholders are the ultimate owners. And who is the management? Management is the one who runs the organization, who takes certain decisions in order to run the organizations. So shareholder provides the finances to the managers, and managers are the one who work as agent and run the organization. There exists the separation between owners and management. So the owners goal will be the wealth maximization, their profits. What will be the management goal? Management's goal will be the organization's wealth maximization. So that was all from first lecture. I hope you understood what is the finance and its interrelated areas. Financial management, three important financial management decisions, goal of a firm, and the structure of modern corporation.